The global financial crisis of 2008 was one of the most significant economic events in modern history. It was a worldwide meltdown that shook the foundations of the global financial system and had far-reaching consequences for millions of people around the world. In this video, we will explore the causes and consequences of the crisis and examine the lessons that can be learned from this tumultuous period in our economic history. The crisis began in the United States in 2007, but quickly spread to other parts of the world, causing widespread panic and economic turmoil. The crisis was triggered by a combination of factors, including a housing bubble, lax lending standards, and a complex web of financial instruments that were poorly understood by many investors. As the crisis deepened, it became clear that the entire global financial system was at risk. Banks and other financial institutions around the world were heavily invested in the risky assets that had caused the crisis, and many of them were on the brink of collapse. Governments around the world responded with a range of measures, including bailouts, stimulus packages, and regulatory reforms. These measures helped to stabilize the financial system and prevent a complete collapse, but they also had significant economic and political consequences. In the years since the crisis, there has been much debate about the causes and consequences of the meltdown. Some argue that it was the result of greed and recklessness on the part of bankers and investors, while others point to broader economic and political factors. In this video, we will explore these issues in depth and examine the lessons that can be learned from this tumultuous period in our economic history. Join us as we take a closer look at the global financial crisis, a worldwide meltdown. The global financial crisis was caused by a complex web of factors that came together to create a perfect storm. At the heart of the crisis was a housing bubble in the United States, fueled by lax lending standards and a proliferation of complex financial instruments. Banks and other financial institutions were eager to lend money to people who could not afford to repay their loans, and they packaged these risky loans into complex financial instruments known as mortgage-backed securities. These securities were then sold to investors around the world, who believed that they were investing in a safe and secure asset. However, when the housing bubble burst, many of these securities became worthless, causing massive losses for investors and financial institutions. The crisis was also exacerbated by a lack of regulation and oversight in the financial industry. Many financial institutions engaged in risky and speculative behavior, taking on huge amounts of debt and investing in complex financial instruments that they did not fully understand. When the crisis hit, many of these institutions were unable to meet their obligations, leading to a wave of bank failures and a freeze in credit markets. The crisis was not limited to the United States, however. Many other countries were also affected by the crisis, as they were heavily invested in the risky assets that had caused the meltdown. In the next segment, we will explore the global impact of the crisis and examine the measures that were taken to stabilize the financial system and prevent a complete collapse. The global financial crisis had a profound impact on economies around the world. As the crisis spread, it caused widespread panic and economic turmoil, leading to a wave of bank failures, job losses, and foreclosures. The crisis was particularly severe in countries that were heavily invested in the risky assets that had caused the meltdown. Many of these countries experienced severe recessions, with high levels of unemployment and a sharp decline in economic activity. The crisis also had a significant impact on the global financial system. Banks and other financial institutions around the world were heavily invested in the risky assets that had caused the crisis, and many of them were on the brink of collapse. Governments around the world responded with a range of measures to stabilize the financial system and prevent a complete collapse. These measures included bailouts, stimulus packages, and regulatory reforms. While these measures helped to prevent a complete collapse of the financial system, they also had significant economic and political consequences. Many governments were forced to take on large amounts of debt to fund their bailouts and stimulus packages, leading to concerns about long-term fiscal sustainability. The crisis also had significant political consequences, as many people around the world became disillusioned with the financial system and the political establishment. This led to a wave of protests and political unrest in many countries. In the next segment, we will examine the measures that were taken to prevent a future financial crisis and explore the lessons that can be learned from the global financial crisis. The global financial crisis was a wake-up call for governments, regulators, and financial institutions around the world. It exposed the weaknesses and vulnerabilities of the global financial system and highlighted the need for greater regulation and oversight. In the years since the crisis, there have been significant efforts to reform the financial system and prevent a future crisis. These efforts have included new regulations, increased oversight, and greater transparency in financial markets. One of the key lessons learned from the crisis is the importance of risk management. Financial institutions must have effective risk management systems in place to identify and manage potential risks, and regulators must have the tools and resources to monitor and enforce these systems. Another lesson learned from the crisis is the importance of transparency in financial markets. Investors and regulators must have access to accurate and timely information about financial instruments and markets in order to make informed decisions and prevent fraud and abuse. Finally, the crisis highlighted the need for greater international cooperation and coordination in financial regulation. The global financial system is highly interconnected, and a crisis in one country can quickly spread to others. International cooperation is essential to prevent a future crisis and ensure the stability of the global financial system. While significant progress has been made in reforming the financial system since the crisis, there is still much work to be done. The lessons learned from the crisis must be continually revisited and reinforced in order to prevent a future financial meltdown. In the final segment, we will examine the ongoing challenges and risks facing the global financial system and explore the steps that can be taken to ensure its long-term stability and sustainability. The global financial crisis was a painful reminder of the risks and vulnerabilities of the global financial system. While significant progress has been made in reforming the system since the crisis, there are still ongoing challenges and risks that must be addressed. One of the key challenges facing the financial system is the risk of another financial crisis. While many reforms have been implemented since the crisis, there are still concerns about the stability and resilience of the financial system. Another challenge facing the financial system is the ongoing issue of income inequality. The crisis had a disproportionate impact on low-income and middle-class households, and many people around the world continue to struggle with economic insecurity and financial hardship. In order to address these challenges and ensure the long-term stability and sustainability of the financial system, there are several steps that can be taken. First, there must be continued efforts to strengthen financial regulation and oversight. This includes implementing new regulations and strengthening existing ones, as well as ensuring that regulators have the resources and tools they need to monitor and enforce these regulations. Second, there must be greater efforts to promote financial inclusion and reduce income inequality. This includes providing access to financial services and education for low-income and marginalized communities, as well as implementing policies that promote greater economic equality. Finally, there must be greater international cooperation and coordination in financial regulation. The global financial system is highly interconnected, and a crisis in one country can quickly spread to others. International cooperation is essential to prevent a future crisis and ensure the stability of the global financial system. In conclusion, the global financial crisis was a painful reminder of the risks and vulnerabilities of the global financial system. While significant progress has been made in reforming the system since the crisis, there are still ongoing challenges and risks that must be addressed. By implementing effective regulation, promoting financial inclusion, and promoting international cooperation, we can ensure the long-term stability and sustainability of the financial system. Thank you for joining us on this journey through the global financial crisis, a worldwide meltdown.